For the first time ever, I'm going to take a look at Kilroy Realty stock, ticker symbol KRC. This stock is flat year to date, but gained some momentum in the past months as did other REITs. Taking a quick peek at their dividends, I really understand why investors would love this stock. We got a 5.3% dividend yield and 8 consecutive years of dividend increases. But there's a big problem. The 5-year return is at nearly minus 40%. And keep in mind that this graph is including dividends. Meanwhile, the S&P 500 managed to get a nearly 100% return in those 5 years. But this doesn't mean anything for the future. So the big question of today is, should you buy KRC stock right now? Well, looking at the earnings, we see that KRC beat on both the FFO and revenue most recently. For the upcoming earnings analysis, expect a miss. Diving a bit more into detail, we see that revenue grew 2.2% year over year. Not too exciting if you ask me. Especially if we take a look at the net income, which is down a little bit year over year. But KRC managed to report an increase in FFO of 5.4%, which is one of the most important numbers for REITs. The occupancy rate is also very important, especially for KRC, since they have a focus on office spaces. We see that this number is reported at 84%, which is a bit on the lower side. Of course, we have to take into account the industry focus, but still, 84% is something that I don't like. I prefer at least 90% here for this type of company. And as of right now, KRC has B credit ratings, which is not too bad. But I prefer A credit ratings here, to be honest. The debt to EBITDA ratio is at 6.2 times, which is a great number. This comforts me a lot, since I prefer a range of 5 to 6.5 here. According to KRC, the deceleration of groundbreakings will create a future shortage of high-quality products, or buildings in this case. This is something that could be huge for KRC. On the other hand, I do think that it is still a risk to be in this type of business, a high exposure to office buildings. And now that we know a bit more about the company, it is time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe to my channel to receive multiple analysis every week. And also join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue by diving into the fundamentals. KRC is a 4.9 billion market cap company. PE ratio is not a fair metric to use with REITs, so I'll be using the price to FFO instead. Right now it is sitting at 8.8, indicating they might be undervalued. Later in this video I will show you my 3 price targets for KRC stock, so make sure to watch until the end, because price to FFO is only telling a small part of the full story here. Revenue is at 1.1 billion, and in this graph we see that revenue went up in the long run. However, most recently it is slowing down a lot. We see that gross margins are dropping pretty hard, which is something that worries me a lot. The operating margin is up in the long run, and so is the net margin, so that comforts me a lot in this case. EPS is showing similar trends as the margin and the revenue. For a REIT, it looks pretty decent. Analysts expect that from here EPS will stay pretty flat, with some big up and downs in between. For the revenue, it is expected to see a small increase compared to 2029. And again, it is not really steady and consistent, right? They expect. Return on assets is sitting at 1.7%, which is a low number for a REIT. Return on equity is also looking really low, and the most important number, return on invested capital, is sitting at 2%, which is a low number, even for a REIT. It is slightly higher versus the 5-year average, which is the silver lining here. Current ratio is at 1.4, which is a decent number for a REIT, nothing special to mention here. And right now, Kilroy has $5 billion in debt. I prefer companies that can pay down at least a big chunk of their total debt with the total cash. Kilroy has $625 million in total cash, so they can't pay down a big chunk of their total debt. This is something that I don't like. So it is very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends and all other things. And here we see that free cash flow is going up in the long run, which is a great thing. It is actually looking pretty interesting, since it was at a negative number, but most recently they managed to report a positive cash flow. Shares outstanding are increasing, which is very common for REITs, since they increase shares to raise capital. But when shares outstanding are decreasing, it increases your ownership in the company, increases EPS, lowers the P/E ratio, and makes it easier to maintain and increase the dividends. And since we're talking about dividends anyways, dividend yield is sitting at 5.3%, which is an insane number. Annual payout is at $2.16 and payout ratio is around 50%, which is really low for a REIT, so that's very interesting. Especially since the 5-year growth rate is at 2.8%, which is a bit of a low number. But they managed to increase that dividend 8 years in a row, which is really impressive on the other hand. And in here we see the dividends paid since 2014. And to me this looks really good. KRC really likes to increase the dividend at a low rate, but over a longer period of time this really adds up. In this graph we see the expected dividends in 2025 and 2026. Of course this is an estimation and can be highly impacted by results, but it gives you a rough indication. It is expected to grow at a low rate from here. And overall the dividends look pretty good to me, but how about the historical returns? I decided to compare KRC stock with the overall market, in this case the S&P 500. On the 5-year chart we see that KRC had a minus 38% return, which is not looking any good, especially since this number is including dividends. The S&P 500 reported a nearly 100% return. On the 1-year chart things start to look a little better, with a 7% return for KRC. But the S&P 500 again beats KRC quite easily with a 27% return. On the 6-month chart it is finally KRC who is winning with a whopping 35% return, massively outperforming the S&P 500. On the 1-month chart it is the S&P 500 again who is the winner, but it is pretty close I would say. So bottom line, the S&P 500 was by far the better investment in the past 5 years. But there was a brief period where it seems that KRC was catching some momentum. So could this be the perfect time to buy KRC stock? Well, let's check the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets. For the revenue growth I'm filling in 4, 6 and 8%, based on historical performance, their own outlook, but also because of the analysis. For the profit margin I'm filling in 15, 17 and 19%. And for the free cash flow margin I'm putting in the same numbers. For the P/E ratio I'm putting in 20 since it is a REIT. And for the price of free cash flow I'm putting in 14, 16 and 18. My desired annual return is 12.5% since I get an easy 10% average annual return with owning an ETF. Right now, KRC stock is around $41. I hit analyze, and we see a lot of red numbers. And since this is a REIT, I'm only focusing on the discounted cash flow value. We have a low price target of $17.8. We have a mid price target of $25. And we have a high price target of $35. To me, the mid to high price target is the most justified here, indicating that this stock is still massively overvalued. And keep in mind, my numbers were already pretty positive. Please let me know the price target that you think is the most justified in the comments down below. My final conclusion on KRC is that the dividend scorecard is actually not looking that bad. The growth is a bit lacking, but that makes sense looking at the other numbers. Revenue isn't really going anywhere lately, and the margins are also not increasing. Down the line, this could be a problem for the future, even leading to a dividend cut if the company fails to deliver. But we are not there yet. For now, I'm skipping this stock since, to me, the lack of growth is a really big problem. There are other REITs out there with a similar dividend yield, but way better fundamentals than this company does. But it has an interesting niche focus, so I will be analyzing them from time to time. And remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and it did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.